Did you know that during major economic crises, like the one we saw in 2008 and the downturn in 2020, a huge number of American households find themselves in serious financial trouble? We're talking job losses, vanishing income, and watching home and stock values evaporate. Many are forced to cut back on everything, even essentials. Now, what if I told you that a convergence of global pressures is setting the stage for an event that some economists predict could be far more significant than the last two recessions? One specific theory, based on a historical 18-year cycle, points directly to 2026 as the next major downturn. While most people might be sleepwalking towards this potential disaster, a small group of investors is making quiet, deliberate moves. They aren't just trying to survive, they're positioning themselves to come out of the chaos stronger than before. This isn't about fear, this is about foresight. And in this video, I'm pulling back the curtain on the exact blueprint I'm using to prepare my wealth, my income, and my family for what's coming. Stick with me, because this could be the most important financial guidance you receive all year. Welcome to the channel. Today we're talking about something most people are afraid to even think about, let alone discuss openly: the rising probability of a major financial reckoning in or around 2026. Now, this isn't a prediction I've pulled from thin air. It's a conclusion based on a disturbing alignment of economic indicators, geopolitical tensions, and historical cycles that are all pointing in the same direction. Some economists and analysts, like Fred Harrison, have pointed to the 18-year business cycle, which, if it holds true, points to 2026 as the next major downturn. While this isn't a consensus view among major institutions like the IMF or World Bank, who see slowing growth but not a specific collapse, the underlying risks are acknowledged by almost everyone. Some even warn this event will be much worse than 2008, because this time governments may not have the same power to bail out the system. My goal here isn't to create panic. Panic leads to terrible decisions. My goal is to spark preparation, because with a solid plan, you can navigate any storm. Over the next 30 minutes, I'm going to give you my personal, comprehensive playbook. First, we'll break down the warning signs that are flashing brighter every day to understand the why behind this potential crisis. Then, and this is the most important part, I will walk you through, step by step, the actionable strategies I am personally implementing. This is a multi-layered defense system designed to not only protect what you have, but to seize the incredible opportunities that are always born from periods of maximum fear. This is about transforming yourself from a potential victim into a prepared strategic player. To prepare for a storm, you first have to learn to read the sky. The signs of a coming financial storm aren't hidden. They're in plain sight for anyone willing to look. What we're seeing is not a single point of failure, but a systemic fragility built up over more than a decade. Let's break down the four key pillars of this impending crisis. Part A, the Great Valuation Bubble. First, let's talk about market valuations. Think of the stock market like any other item. There are times it's fairly priced, times it's on sale, and times it is dangerously overpriced. Right now, several historically reliable indicators are screaming that we are in one of the most overvalued markets in history. The most famous of these is the Shiller Cyclically Adjusted Price to Earnings Ratio, or CAPE ratio. In simple terms, this tool measures how expensive the stock market is relative to its average inflation-adjusted earnings over 10 years. Historically, the long-term average for the CAPE ratio is around 16 or 17. As of October 2025, the ratio is elevated in the mid to high 30s. To put that in perspective, this is a level that has only been significantly surpassed twice since 1881. Just before the crash of 1929 and at the peak of the dot-com bubble in 1999. Each time, a major market crash followed. When you pay such a high price for each dollar of earnings, your margin for error becomes razor thin. Another indicator, a favorite of Warren Buffett, compares the total value of the stock market to the country's GDP. Buffett himself called it probably the best single measure of where valuations stand at any given moment, and warned that when the ratio gets close to 200%, you are playing with fire. We have been dancing in and out of that fire zone, with the indicator recently reaching some of its highest levels on record, well above 160%. These aren't just numbers on a chart, they are historical warnings of danger. Part B, policy shocks and geopolitical instability. A fragile system is most vulnerable to external shocks, and the world stage is currently fraught with them. Global growth is slowing down. Forecasts for 2025 and 2026 have been downgraded, with a tepid recovery at best. In 2025, we've seen abrupt changes in U.S. trade policy trigger renewed economic shocks. The imposition of sweeping tariffs and the resulting trade tensions are not just political headlines, They are direct threats to global economic stability. These policies increase costs, disrupt supply chains, and damage business confidence. The OECD and IMF project global growth to slow to around 2.9% to 3.2% through 2026, a significant drop from previous years, largely due to these protectionist policies and geopolitical tensions. Imagine the global economy as an intricate web of connections. A trade war is like taking a pair of scissors to that web. Things that used to flow freely, goods, capital, resources, suddenly stop. This creates bottlenecks, raises prices, and forces businesses to rethink everything, which can lead to layoffs and economic contraction. We are in an era of geopolitical chess where economic weapons are being used aggressively, and the fallout could create the very panic that ignites a market crash. Part C: the unprecedented mountain of debt. The fuel that has powered these bubbles and allowed the system to ignore fundamentals for so long is debt. And we are currently sitting on the largest pile of debt the world has ever seen. As of late 2025, total global debt is at a staggering level, with some estimates putting it over $300 trillion. The global debt to GDP ratio is over 235%. This debt is everywhere. In the US, general government debt has risen to around 124% of GDP. One former IMF official has warned that this rising debt, coupled with eroding trust in US institutions, is creating a debt time bomb. The risk is that if this debt continues to spiral, US bonds could lose their status as the ultimate safe asset, crippling the government's ability to intervene in a crisis as it did in 2008. It's not just governments. Corporate debt has also exploded. Worryingly, much of this borrowed money wasn't used for productive investments. Instead, it was used for financial engineering like stock buybacks, which boosts share prices in the short term but leaves the company more vulnerable in the long run. This mountain of debt is the pin that threatens to prick the everything bubble. Part D: the fragile consumer. The final pillar of concern is you, me, all of us, the consumer. Consumer spending is the engine of the US economy. That engine is sputtering. Delinquency rates on credit cards and auto loans are rising. American households have now accumulated a record level of credit card debt topping $1.2 trillion. With savings dwindling and the cost of living remaining high, the consumer is being squeezed from all sides. A significant market downturn would be the final blow, likely triggering a sharp drop in spending as consumer confidence evaporates. These four factors: extreme valuations, geopolitical shocks, unprecedented debt, and a fragile consumer, are not independent. They are interconnected and feeding off each other, creating a feedback loop of increasing risk. The system has become a house of cards, and the wind is picking up. Every time a crash looms, you'll hear the phrase, "this time is different." Often, it's used to justify why bubbles can keep inflating. But I believe this time truly is different, for reasons that make the situation far more perilous than in 2000 or 2008. The everything bubble. In 2000, the crash was largely in the tech sector. In 2008, it was the housing market. Today, we face what many analysts are calling the everything bubble. It's not just tech stocks at nosebleed valuations. It's the broader stock market, the housing market, the bond market, even alternative assets. While not a consensus view among all economists, the term captures the widespread inflation of asset prices. When everything is inflated at once, there's nowhere to hide. Normally, investors flee stocks and find safety in bonds. But what happens when the bond bubble itself is at risk? When everything falls at once, traditional diversification fails. This is the unique danger of the everything bubble. The collapse of one asset class could trigger a domino effect, bringing the whole structure down. The end of an era, easy money. For decades, and especially since 2008, the financial system was powered by one thing: cheap, easy money from central banks. This made borrowing incredibly cheap, fueling the massive debt we just discussed. It punished savers and pushed everyone into riskier assets to find a decent return. That flood of money had to go somewhere, and it went into stocks, real estate, and everything else, inflating the bubble. But that era is over. Faced with inflation, central banks hiked interest rates aggressively in 2022 and 2023. While they have begun to trim rates in 2025 in response to a slowing economy, rates remain well above the near zero levels the system was built on. Interest rates are the gravity of financial markets. For years, gravity was turned off. Now it's being cranked back up. Businesses that were only profitable because they could borrow for free are now facing a wall of refinancing at much higher costs. This fundamental shift is the primary catalyst that could bring the entire overleveraged, overvalued structure crashing down. The psychological accelerant: modern investor mania. The final factor that makes this time different is market psychology. Social media has completely changed how information and misinformation spreads. We live in an age of meme stocks and a fear of missing out, FOMO, that has conditioned a generation of investors to buy the dip without question, believing markets only go up. This can fuel a bubble to irrational heights, but it also creates a terrifying potential for a crash. When the trend finally turns, those same psychological forces will work in reverse. FOMO will be replaced by panic. The rapid fire communication of social media will spread fear just as quickly as it once spread greed. Panic selling can become a self fulfilling prophecy, driving prices far below their real value. This isn't just about financial loss, it's about the devastating mental health consequences that follow. When we combine an everything bubble, the end of the easy money era, and a psychologically fragile market, we have a recipe for a crisis that could be uniquely severe. If this breakdown is making sense to you and you're starting to see why taking action now is so critical, then do me a small favor and hit that subscribe button and turn on notifications. I release in-depth videos just like this every week, designed to give you the clarity and tools you need to not just survive what's coming, but to build real, lasting wealth. Don't miss the next one. All right, we've diagnosed the problem. Now for the most important part, the solution. This isn't just theory. This is my personal, multi-layered blueprint for preparing for 2026. It's built around one core principle: resilience. It's about building a financial fortress that can withstand the storm, and just as importantly, giving you the resources to go on the offensive when the time is right. Strategy 1: fortifying the foundation, the cash fortress. The absolute bedrock of any defensive strategy is cash. And I'm not talking about the standard 3 to 6 month emergency fund. In the face of a potential multi-year downturn, that's not nearly enough. My first strategy is to build what I call a cash fortress. This means holding a minimum of 12 months and ideally closer to 24 months of essential living expenses in liquid, safe, and accessible cash. This money is not in the stock market. It's in high yield savings accounts, money market funds, or short-term treasury bills. Why so much? This cash serves two critical purposes. First, it is your ultimate defense. It ensures that no matter what happens to your job or investments, you can pay your mortgage and buy groceries without being forced to sell your assets at the worst possible time. Being forced to sell at the bottom of a crash is how wealth is permanently destroyed. Cash prevents this, it buys you time. Second, and this is where we shift from defense to offense, this cash is your dry powder. Warren Buffett's famous advice is to be greedy when others are fearful. A market crash is the greatest sale on financial assets you will ever see. Stocks of world-class companies and real estate get thrown out at fire sale prices. Those who have cash are the ones who can build generational wealth. While everyone else is panicking, you can be calm, strategic, and start buying incredible assets at a massive discount. During the sharp crash of March 2020, it was my significant cash position that gave me the confidence and capital to buy heavily when it felt like the world was ending. That single move had an outsized impact on my net worth. Cash isn't trash. It's power, safety, and opportunity. Strategy 2: rethinking diversification for the modern age. For decades, the gold standard was the 60-40 portfolio: 60% stocks, 40% bonds. I believe this model is broken and could be dangerous. As we discussed, in an everything bubble scenario, it's possible for both stocks and bonds to fall at the same time. If investors lose faith in bonds due to massive government debt, your safe haven becomes a source of loss. We need to rethink what true diversification looks like. My approach is a broader diversification across assets that don't all move in the same direction. Physical assets, gold and silver. For thousands of years, gold has been the ultimate store of value during times of crisis and currency debasement. It's a physical asset with no counterparty risk. Its role isn't to generate income, its role is to act as insurance. When faith in paper money falters, gold tends to shine. I hold a meaningful allocation to physical gold and silver, stored securely. Global diversification, selectively. This does not mean simply buying an international index fund. Many international economies are just as fragile as the US. Instead, it means selectively investing in countries and sectors that are more resilient, those with lower debt, better demographics, or control over critical resources. Productive, real assets. Beyond precious metals, I believe in owning assets that produce real value. For some, this could be investment real estate that generates rent. For others, it might be an investment in farmland or infrastructure. These assets have a physical component and an income stream that is often less correlated with the stock market. The goal is to build a portfolio where different parts will react differently to a crisis, ensuring that a collapse in one area doesn't sink the entire ship. Strategy 3, the barbell. Strategy, extreme safety and extreme opportunity. This concept, popularized by Nassim Nicholas Taleb, is perfectly suited for today's uncertain world. The idea is to avoid the mushy middle of medium risk investments and instead structure your portfolio like a barbell. On one side, you place the vast majority of your assets, say 80% to 90%, in extremely safe investments. This is your cash fortress and other guaranteed assets like short-term government bonds. This portion is protected from any and all downside. You won't get rich from this side, but it ensures your survival. On the other, much smaller side, you place the remaining 10% to 20% in highly speculative, high reward ventures. These could be investments in venture capital, startups, or specific technologies that have the potential for explosive 10x or 100x growth. The key here is the asymmetry. Your downside is strictly limited to that small percentage, but your upside is virtually unlimited. If just one of those speculative bets pays off, it can have a massive impact on your overall net worth. This structure allows you to be incredibly conservative and incredibly aggressive at the same time. Strategy 4, active hedging, portfolio insurance. This is a more advanced strategy and it's not for everyone, but it can be a powerful tool. Hedging is essentially buying insurance for your portfolio. The most common way to do this is with put options on a market index like the S&P 500. Think of it like homeowners insurance. You pay a premium every year. Most years you lose that money because your house doesn't burn down, but you pay it for peace of mind. A put option is similar. You pay a premium for it. If the market goes up, your option expires worthless. But if the market crashes, the value of that put option can soar, and the gains can substantially offset the losses in your stock portfolio. This isn't about timing the market. It's about managing risk. It's acknowledging a storm is likely and deciding to pay a small price to insure your assets. This requires a deep understanding of options, so do your research before attempting it. These 4 strategies, the cash fortress, modern diversification, the barbell strategy, and active hedging, form the core of my financial preparations for 2026. A financial collapse isn't just a numbers on a screen event. It affects every part of our lives. Protecting your portfolio is only half the battle. True preparation is about building personal resilience. 1. Income diversification. Kill your single paycheck. The single greatest vulnerability for most people is relying on one job for 100% of their income. In a severe recession, even secure white-collar jobs are not safe. The antidote is income diversification. Now is the time to actively build multiple streams of income. This can start small. Freelancing, turn a professional skill, writing, design, coding into a side business. Side hustle, provide a service in your local community like tutoring or home repairs. Digital business, build a small online store, a niche blog, or a YouTube channel. The goal is that if your primary income source disappears, you are not at zero. A job can be taken from you, a diverse set of income skills cannot. 2. Skill stacking, invest in yourself. In a post-crash world, the economic landscape will change. The most valuable asset you can own is a stack of relevant skills. Think about what will be indispensable. Technology. Skills in AI, data analysis, and cybersecurity will remain in high demand. Trades. People will always need plumbers, electricians, and mechanics. Communication and sales. The ability to persuade and sell is timeless. Self-sufficiency. Think skills our grandparents had. Gardening. Basic home repairs. Cooking from scratch. These reduce your reliance on fragile supply chains and save you money. Your knowledge is a portfolio that can never be wiped out in a market crash. 3. Network and community, your human capital. In a crisis, the strength of your personal network can be more valuable than your financial capital. The people you know are your support system. Now is the time to intentionally cultivate these relationships. Check in on your neighbors, offer help, be active, build a reputation as someone who is reliable and helpful. When times get tough, this network will be what helps you find a new job, get a business lead, or just get through it. 4. Mental fortitude, win the inner game. Finally, you must prepare yourself psychologically. A financial collapse is terrifying. The news will be a constant stream of negativity. The pressure will be immense. Winning requires mental fortitude. Have a plan. The best antidote to fear is a plan. Write it down. Know exactly what you will do when the market starts to fall. Long-term perspective. Remember that all market crashes in history have eventually been followed by a recovery. This too shall pass. Limit your news intake. Don't stay glued to financial news 24/7. It will only feed your anxiety. Stick to your plan. Focus on what you can control. You can't control the Federal Reserve or geopolitics. You can control Control your savings, your spending, your skills, and your preparation. Focus all your energy there. Building personal resilience is the final crucial layer of your fortress. Now, I've shared my complete blueprint, but this is a conversation. I know there is a tremendous amount of wisdom in this community. So I want to hear from you. What are you doing to prepare for what might be coming in 2026? What is your single biggest concern? Are there strategies I missed? Drop a comment below. Let's share our knowledge and help each other become more prepared. We've covered a huge amount of ground today. We looked at the ominous signs, the everything bubble, geopolitical shocks, the mountain of global debt, and the fragile consumer. We talked about why this time is different thanks to the end of the easy money era and the speed of modern market psychology, but we didn't stop there. We walked through my 4-part blueprint for financial defense, building a cash fortress, modernizing diversification, using the barbell strategy, and exploring hedging. And we went beyond the portfolio to discuss building personal resilience in your income, skills, community, and mindset. The purpose of this is not to predict the exact date of a crash. No one can. The purpose is to prepare for the inevitability of cycles. History shows that periods of excess are always followed by periods of correction. To ignore that is to choose to be a victim. The moves you make today in the relative calm before the storm will determine where you stand tomorrow. You can be the person forced to sell at the bottom, or you can be the person who is buying. You can be the ship wrecked by the waves, or you can be the lighthouse, prepared, unshakable, and a beacon for others. The future is uncertain, but your preparation doesn't have to be. The power is in your hands. If this video gave you clarity and a real plan, please do 2 things for me. First, hit that like button to let me know this was valuable. Second, share it with at least one person you care about. We all have a responsibility to help those around us prepare. And finally, if you haven't already, make sure you're subscribed so you don't miss the next video in this critical series. Thank you for your time. Be safe and be prepared.